dissolution of the firm. But on appeal, anyone know what happened to the conviction on appeal? It was reversed. So Anderson did not stand convicted of any of the criminal charges. But by that time, the firm was gone, and it was too late to bring it back. So I think had the government realized that it would destroy a major CPA firm with international connections as well, I don't think they would have brought criminal charges. There certainly would have been some reprimands. Certainly there would have been some Arthur Andersen personnel who maybe would have been charged, or maybe would have been certainly forced to resign. And certainly the Enron people and so forth. Remember, one of the Enron executives was Tom Skilling's brother. Yeah, the weather guy, yeah. His brother, yeah, Jeff Skilling was one, because he was an acting CEO for a while during these tumultuous times and got sent to Club Fed.
I may be remembering wrong, but
yes, go ahead.
Didn't the SEC have an office in like WorldCom? Or
I don't remember. They may have.
Or?
You know, it's interesting. The WorldCom misstatements were much greater than the ones in Enron. We always hear about Enron, right, but it was WorldCom. And if WorldCom had not occurred, I don't think we'd have Sarbanes-Oxley. I know we had the Enron situation, but the public memory is short. It's just that when WorldCom followed right after that, and you may be right.
Yeah, I think the SEC actually had an office in the WorldCom building.
Which means they should have been aware of what was going on.
Right.
That's why the idea of the SEC then setting up this PCAOB and saying, we're going to control your profession, you can't control yourself. And there's a number of other cases where the SEC should have been alerted to security scams, and they weren't.
Like,
I'm not a big fan of the SEC.
It's like Bernie Madoff. I mean, they, you know.
Oh, yes.
Yeah.
Oh,
we know about that particular scandal. They talk about the international standards on auditing, and of course you probably see now that this is also true for accounting, that we now have the international boards working together with the U.S. groups, coming up with unified standards. We see this for the FASB's member are now international standards, like the new one on revenue recognition, because of this coordination. The generally accepted auditing standards, that's on page 34, they had a multiple choice question on the midterm. They had the same question twice with the same answers, but they had, in one of them the answer was like A, the other one the answer was C, and I could not find the answer anywhere in this text. I thought several of the answers were correct, so I deleted it. Because if I can't do it, then how can I expect you to do it? It asked about generally accepted auditing standards. Now, maybe I could have rewritten the question. But I decided that, wait a second. The question and answers are the same, but you're saying the answer is different on one versus the other. It makes no sense. So, but these are the standards, and let's take a look at them on page 35. The auditor, the general standards. The auditor must have adequate technical training and proficiency to perform the audit. One of the homework problems, I think it's Home CPA that I assigned in Chapter 2, talks about taking a couple students and telling them to do a compilation review. They obviously don't have training. And I must confess, just coming out of school, if you got hired in public accounting after completing your color degree, which certainly means you have some skills, and then passing the CPA exam, I don't think you should be turned loose directly on an audit unless it was doing a very clerical function. Or here, can you make these copies for me? Or whatever it is. Or pull these invoices by these numbers. Because that's why the public accounting firms have training programs. And we had, as I said, ours was 3 weeks of training. The auditor must maintain independence and mental attitude in all matters relating to the audit. Now, part of that will be maintained through like the AICPA rules, like Rule 101, which are still adopted, even though we now have Sarbanes-Oxley. The auditor must exercise due professional care in the performance of the audit and the preparation of the report. Certainly. Due professional care in accordance with generally accepted auditing standards. Standards of field work. The auditor must adequately plan the work and must properly supervise any assistance. Our textbook has some stuff, and there's a question on one of the exams involving planning an audit. I have created my own listing of I think I have 18 or something different steps in preparing an audit. That is a key factor. And I even oriented the listing, we'll go over it in class when we get to that chapter, for going out of town. If you're on an out-of-town audit, that's part of the planning too. What do you have to do if you have an out-of-town audit? What would be some additional steps you would have to engage in? You have to, I'm signing you to go to Quincy for 10 weeks.
Where are you going to stay at first?
That's part of it, exactly. We stayed at a Holiday Inn. Nowadays, there's probably would be cheaper to stay at an extended suites hotel,
Yeah.
but they didn't have those then. Transportation. I remember we flew out of O'Hare on Ozark Airlines with propellers. They called it prop jets, but it had propellers. And I think Quincy was the fourth stop. You know, we went to Galesburg and we went to Springfield and somewhere else. Then it went to Quincy, and then it went to St. Louis, the Lambert Field. No, these are steps. And equipment. We used to send like foot lockers out to a location so we could put our papers in there. Of course, now, especially in my era, it was mostly paper. So we could lock them up with padlocks at night when we weren't there. So, I mean, there's a lot of logistical matters as well, as opposed to, let's say, you're auditing a company that's downtown here. So we'll go through all those steps and things too, because remember, in planning an audit, it's those 4 items. It's the audit procedures, the sample sizes, how to select the sample, and don't forget the timing of the audit procedures. A lot of the stuff on one of the exams deals with analytical procedures. That's going to be important for different stages of the audit. I always looked upon that in the planning as well. That's the horizontal, vertical analysis and the ratios. Now they have in some multiple choice some weird answers on some of the exams for that, so I'll give a little extra guidance so you get the exam question right. Then it says the auditor must obtain a sufficient understanding of the entity and its environment, including its internal control. Now remember, this comes from before Sarbanes-Oxley. This is before Section 404. The review of the system of internal control was always part of the audit. To assess the risk of material misstatement of the financials, whether due to error or fraud, and to design the nature, timing, and extent. Notice nature, timing, and extent of further audit procedures. Now, let's comment on part of that. Let's say you are working in public accounting. You've had some generalized audit training. Would you feel comfortable going and auditing a major utility like ComEd or Nicor Gas? No. Anderson has specialized group. I was in manufacturing, but we had a lot of utility clients, and they had their own group, and they had specialized training because utilities, often don't follow general GAAP. They follow regulatory accounting. So we had a group we had a lot of nonprofits. That was a special group because there's special rules for that particular industry. We had a group that audited insurance companies. And again, they had their own specialized training. Now normally, so we want to make sure you're trained for that industry. How could we guarantee, let's say you're an audit senior or an audit manager. How about experience with the client? Who should be assigned, let's say, to be an audit senior on the client or the audit manager? So they
that's worked with the.
Yes, exactly. Somebody who worked on the audit. Maybe when they were an inexperienced and experienced assistant, they were on the ComEd audit. Now they become a senior, we'll put them on that audit because they know the client. Now there is a rule under Sarbanes-Oxley where partners have to rotate because, now let's be honest, cynical now, excuse this is off the record. What do audit partners normally do on an audit? What is their primary function? Well, you would think that they're supposed to oversee everything. Normally, the audit partner would come out maybe 3 times during the audit, do a token work paper, and spend the rest of the time golfing with the CEO or something, or hanging out with the controller. It used to be basically, it was more of a public relations thing to solidify the relationship with the client. Maybe that's why there has to be audit partner rotation, so we're not too friendly. There's a homework problem coming up. It says where there's an auditor and then there's a female owner of a firm. And the female owner of the firm apparently and the auditor are really close buddies. They're both ladies. And I don't know if they go out drinking on Friday afternoons or something. And the firm owner says, I only have one friend, and that's my auditor. You know, she's my best buddy. Well, that's dangerous for a number of reasons. Number one, can you be objective if you find something? And how are you going to disseminate that? That's why I don't recommend getting too close to clients. I remember I had a situation when I worked at Wolf & Company. That was a national CPA firm. And I had a client who was a very wealthy individual who was always late paying bills. And he introduced me to his niece, and she and I started going out. And the problem was, if anyone in the office heard that I was going to see her, they kept saying, he owes us money. Make sure you collect some of the bill. You know, so I had to drop the relationship because I couldn't stand this pressure. You know, I didn't want to be a bill collector. You know, it's better not to get too involved. Now, the niece there had nothing to do with the firm or anything, and it wouldn't influence any of the work we did. The guy had a lot of investments in enterprises, and that's what we handled. It's not publicly traded, it's privately held. But it's better to kind of keep it out of the office. Now notice, misstatements can be due to error or fraud. Sometimes it's incompetency. Sometimes it's intentional misstatement. We'll talk a lot about fraud, and we've studied fraud in other classes as well. Now there's two areas of fraud, aren't there? One is misstatement of the financials. What's the other one? Where the client is desirous of us performing audit services. Besides the financials being misstated, what else is the other type of fraud?
Cost.
Go ahead.
The cost.
Cost of what?
When they're understating the cost of operation expenses.
Okay, but that be related to misstatements.
Okay.
Misappropriation of assets. That's the one where you find something there, the client is normally really appreciative unless it's the officers of the client who are doing it. You know, somebody's pilfering assets. So one of the things they have coming up in the online discussion, I think it's for next week, talks about SAS 99, brainstorming. Anyone know what that is? It's required on every audit.
Like a focus group?
Yeah, it's like a focus group of the members of the audit team. Let's say we're all on the audit together. This would be a relatively large team. Usually we'd have 1 or 2 less people. But there'd be like 3 or 4 of us. We get together and we say, all right, we've become familiar with the client now. We haven't found anything fraudulent, but what might be the opportunities for fraud to exist here? You know, so we're just kind of brainstorming. It's kind of an academic experience here. it might open up some other areas that we want to investigate. We're not saying there's fraud, we're not suspecting fraud, but it's a required session on every audit. It's part of SAS 99, and it's part of an online discussion topic. So that's part of every audit. We'll get together as a team. Maybe it turns out that Barry was handling a certain area of the audit, and he says, well, I haven't found anything, but there could conceivably be, because of the collection of receivables function and how bad debts are determined, there could be something there, and he might go into some detail. He's not saying there are, but it's something that potentially could happen. So we probably should kind of make up a checklist and check it off to make sure it doesn't exist. The auditor must obtain sufficient appropriate audit evidence by performing audit procedures to provide a reasonable basis for the opinion, etc., for the financial statements. That, of course, is part of generally accepted auditing standards. And remember, maybe I'll talk about this. When I taught this course at another school, I actually had people do a few we had an audit case study, and I had people actually do a few audit papers. I think we did cash, we did accounts receivable, we did inventory or something, where you actually prepared an audit statement, and you know, you use tick marks and all that kind of stuff here. Now a lot of this we can do with spreadsheets, whereas that was all paper at the time. But it was actually handy, you know, to see basically what's involved. I'll talk a little bit about audit coding later on in our text. I'll show you the Anderson coding. It's different from what's in this book as to how we did things, because one audit paper working with another, and how it relates to the audit program, which are the audit procedures that have to be conducted, how you sign off on each audit procedure, and you put down the appropriate work papers that actually demonstrate the results of that audit procedure. A lot of this is computerized today, which is good, because somebody can't sign off on something unless everything has been cleared through the system. But I'll go into that a little bit later, because did you ever work on, did you do any PBCs? What does PBC stand for? Prepared by client. I'm the audit manager. You're the controller. Barry, I'd like you and your people to prepare these work papers. Here's a list and what I'd like to have each one prepared. You know, then you'll have those prepared for me, and then I can perform audit procedures based on those. As much as I can fork off on you is less work for me. Plus, it may reduce the fee, but obviously it's tying up your people, because they're going to have to do this extra work. That's why when auditors come in, everyone groans and moans. They have the regular workload, plus they got to work now and get doing stuff for the auditor. The standards of reporting: the auditor must state in the auditor's report whether the financial statements are presented, and remember the term fairly presented, in accordance, in our case, with GAAP. We don't use terms like accurate. Does the auditor guarantee there's no misstatements? Is there any guarantee?
No.
No. If the auditor did not catch something, is the auditor automatically negligent?
No.
No. That's right. That'll come up next week. As long as you performed in accordance with the generally accepted auditing standards, it could very well be that we did appropriate sampling, we did appropriate audit procedures, but a misstatement did not show up in the sample. Then we'll talk later about what happens when you find about that later, subsequent period events.
So who would get in trouble under like
Sarbanes-Oxley.
Sarbanes-Oxley.
Now their names will live in infamy. Those were the people in the House and Senate who passed that bill through.
So that becomes the managers of the company,
Well, yes, it does, because it's not the auditor's liability, because assuming the auditor met the appropriate standards. I'm going to put some stuff on the board next week, by the way, as my own diagram showing auditor's liability under tort and under contract theory. Tort has several breakouts. But now there again, was it an unintentional error or was it intentional? If it's unintentional, somebody's head may spin because of, incompetency. If it's something intentional, then there could be other, causes, or certainly termination, but then will there be charges filed with the state or with the county based on what happened in that situation? The auditor must identify in the auditor's report those circumstances in which principles have not been consistently observed in the current period in relation to the preceding period. It's interesting to note that the audit report pre-1987 used to have a phrase in the opinion paragraph. They used to say, financial statements have been fairly presented in all material respects, etc., and they talk about what they were, in accordance with GAAP, accepted in the U.S., and there used to be a phrase, on a basis consistent with that of previous years. For some strange reason, in 1987, that's when they changed the audit report. That's the one that's in our text, but unfortunately it's changed again, and that's not in our text, but Bill's got it for you here. They took that phrase out. And I'm not sure why, because consistency is still a part of what audit report is going to be disseminated. So I don't know why someone had the bright idea of, let's take that phrase out. And in the new report, which I'll be giving you today to supplement Chapter 3, they haven't added it back. Consistency is part of the audit, as we see here, but they took it out of the audit opinion paragraph. I'd love to know why. 3, when the auditor determines that information disclosures are not reasonably adequate, the auditor must state so in the auditor's report. What are they talking about, informational disclosures? What are they alluding to in the financials?
Maybe internal control.
That could be, but I'm thinking of something else. When you look at financial statements, in a textbook, they're like 1 or 2 pages. What are they in real life?
Several pages?
Several pages, because there's 10 pages of footnotes. GAAP requires full disclosure. So to me, that means is the appropriate information reflected, if not in the body of the financial statement itself, then in the footnotes to the financials. The footnotes. Those are crucial. Those are crucial.
You're talking about like inventory valuation.
The inventory valuation methods. Or if there's litigation outstanding against the company, there's always got to be a footnote relating to that. Now, in some cases, like with a large company, it might just say, there were numerous lawsuits outstanding against the company, in the totality of which would be immaterial relative to the total assets or total revenues of and name the company. Other cases, it might be information might be more specific. In the opinion of legal counsel, we have set up an estimated loss. This is where the attorneys hate us as auditors. God, I mean, I'm deviating, but I'm getting excited because I haven't done this course in so long, and it's bringing back fond memories. If there's a good likelihood of losing a case, or it is highly suggested that a case be settled for a certain dollar amount, auditors require that that be reflected in the financial statements. Maybe setting up a provision or something for litigation settlement, or an estimated liability, which is a legitimate liability for litigation settlement. Now, the attorneys hate that, because it's like playing poker and you're hiding your hands, but you're making me put my cards up, so everyone can see them. Because obviously, if there's an estimated liability for litigation settlement, what is that saying? That's how much we're willing to settle for. So much for objective negotiations. But as auditors, that's essential. If there's going to be $1 million settlement for a medium-sized company that's publicly traded, that could have a tremendous impact on that particular operation. And that's something that outside third parties, creditors or shareholders, need to know. When the auditor must either express an opinion regarding the financial statements taken as a whole, but it can be in parts, as we'll talk about later, or state that an opinion cannot be expressed in the auditor's report. When the auditor cannot express an overall opinion, the auditor should state the reasons therefore in the auditor's report. In all cases where an auditor's name is associated with financial statements, the auditor should clearly indicate the character of the auditor's work, if any, and the degree of responsibility the auditor is taking. Now, when we're talking about cannot express an opinion, what scenario would be involved there? What scenario are we talking about? What type of audit report are we mentioning in that situation? Which of the 4 types? Where you basically don't know if something is fairly presented or not.
Disclaimer?
That's the disclaimer. That's the disclaimer situation. In some cases, we'll see some of this in the Chapter 3 homework, you might be able to give an unmodified opinion on, let's say, ending balance sheet, but you can't give an opinion on beginning balance sheet, statement of cash flows, or income statement, because maybe, let's say, you were hired at a late date where you could not go back and check that information. Okay, I want to get to some of the problems because I'm anxious to get to Chapter 3, but I'm so loquacious here today. More on the statement of auditing standards. Oh, the elements of quality control. This is one of the homework problems. It's not really essential for exam purposes, but I did assign a homework problem in this area. It appears on page 38. Leadership responsibilities, relevant ethical requirements, and so on. So we'll take a quick look at that. Not that significant, but. And I notice here in Joan Moore's book, she must assign that because she's got the answers written in here in her text. Again, my thanks to Joan for the use of her text. Okay, so let's take a look at the problems here. Now, these you can just write these answers down and then put them in the Dropbox later, and that would be fine. You'll still get credit. But if someone has some answers on this, share it. This 2-19, there's 2 in this chapter, and then I want to get to the other chapter. I guess I'm not going to get to the Chapter 4 today, but that's okay. I'm just enjoying this too much. I hope you are too.
Okay, Chapter 2, 219?
219, right, it's on page 43. 43. Now, I got the answer key for the new edition where these are in a different order, but I'm going to rely here on Joan's answers written in. Now, this goes back again. If some of you said you started into some of this, this goes back actually to page 38, table 2-4. But this is not that important a question per se. It's just that what they're saying in each of these, A through J, is kind of interesting. All right, A, appropriate accounting and auditing research requires adequate technical reference materials. Each firm professional has online password access through the firm's internet website to electronic reference materials on auditing, accounting, tax, SEC, and other technical information, including industry data. So everyone has access to appropriate information. They have password access. Now, some of you may have started this. Did you have a chance?
Engagement performance?
Engagement performance is correct. Very good. Engagement performance. Letter B. Each office of the firm shall be visited at least annually by review persons selected by the Director of Accounting and Auditing. Procedures to be undertaken by the reviewers are illustrated by the Office Review Program.
Monitoring?
Monitoring is correct. Very good. And I'm assuming that was by somebody within the same firm. We also have mandatory peer review where an outside firm comes in and examines items as well. Letter C, you guys are doing great. All potential new clients are reviewed before acceptance. The review includes consultation with predecessor auditors who may not be as friendly because they lost the client, and background checks. All new clients are approved by the firm management committee, including assessing whether the firm has the technical competence to complete the engagement.
Acceptance and continuance of.
Right, acceptance and continuation of clients and engagements. Let me comment on that. At Arthur Andersen, each year, we told certain clients that we did not feel it was appropriate for us to be performing this service on their behalf. Now, the reason we did that was that some clients we felt were too small to justify tying up our personnel. I mean, it's nice to be in that position where you can reject clients because we have enough other clients. Now, I worked for another smaller CPA firm where it was a different reason. We had a client who represented 1/3 of our billings. And I wasn't on the audit side, I was on the tax side. But we got together and decided that something smelled in this client. You know, like fish that's not been refrigerated that's 3 days old. We couldn't detect anything per se, but we felt very uncomfortable. So even though this was 1/3 of our billing, we decided to tell the client that this would be our final engagement. You know, and what if Andersen had done that with Enron? You know, Enron would have been grabbed by Ernst & Young or somebody else. Then maybe they would have been the firm that went down the tubes. Okay, let's go to letter D. Each audit engagement must include a concurring partner review of critical audit decisions.
Engagement performance.
Engagement performance is correct. Letter E. Audit engagement team members enter their electronic signatures in the firm engagement management software to indicate the completion of specific audit program steps. At the end of the audit engagement, the engagement management software will not allow archiving of the engagement file until all the audit program steps have been electronically signed. This is one of the benefits of electronic. When I was doing this, it was manual. So somebody had to go through to make sure every audit step had been signed off on. Now it's electronic, it won't let you continue if there's something still open. You've seen this when you're doing answering a questionnaire and you try and submit and it just says, no, you didn't answer 3B. So you got to go back and, oh yeah, I left that blank. And this would be engagement performance again, yes. Letter F, at all stages of any engagement, an effort is made to involve professional staff at appropriate levels in the accounting and auditing decisions. Various approvals of the manager or senior accountant are obtained throughout the audit. Engagement performance again. Yes. Maybe it will continue for the next one. Let us see. Letter G. No employee will have any direct or indirect financial interest, association, or relationship. For example, a close relative serving a client in a decision-making capacity, not otherwise disclosed, that might be adverse to the firm's best interest.
Relevant ethical requirements?
Yes, Amanda's correct. Relevant ethical requirement. Relevant ethical requirement. Letter H. Individual partners submit the nomination of those persons whom they wish to be considered for partner. To become a partner, individual must have exhibited a high degree of technical competence, must possess integrity, motivation, and judgment, must have a desire to help the firm progress, etc., and must be politically connected with the right people.
Relevant ethics.
Yeah, that's HR, but I'll tell you, let me just comment on that. When, if you, now a lot of you say you're maybe not going into public accounting, but if you go into public accounting, you need to get a senior partner to be like your white knight or your mentor to help pull you through. There's a lot of politics in making partner. It's not all based on all this great stuff about technical competence and willingness to expand the firm. And Unfortunately, for a while, it was how much consulting work you can bring into the client. That's what gave rise to Enron, WorldCom, and Sarbanes-Oxley. I don't know if you've heard of the firm. It's a major Jewish accounting firm, Elshuler, Melvoin, and Glasner. That firm was organized because in the Big Eight, there were no Jewish partners. Christians only. Well, forget Muslims or any other religion now, that's completely gone. Nowadays, that of course is not true. But that's why that firm was set up. For many years after Jewish partners were allowed in the Big Eight, there was only a token female partner. Well, we have our female partners, so we don't need another one. Now, at least we have, I don't see that discrimination now to that degree. But still, regardless of your gender or religion or ethnic origin or race, you need a senior partner to be your mentor, to be your champion. Because there's a lot of politics in making partner. So I guess that's true in a lot of firms, but especially true in a law firm also. All right, so H was HR. I, through our continuing employee evaluation and counseling program and through the quality review procedures as established by the firm, educational needs are reviewed and formal staff training programs are modified to accommodate changing needs. At the conclusion of practice office reviews, apparent accounting and auditing deficiencies are summarized and reported to the firm's director of personnel. Now, Joan has an answer here, and I'm not sure it's right, so I'm going to check my answers.
Is it HR?
Yeah, I must confess this one confuses me. HR is what she has down. I checked it here. Does anyone have another answer?
I thought it was the leadership responsibility as well.
You know, I would not say that was incorrect. You know, leadership responsibilities, I mean, even engagement performance. Well, Joan was right. The model answer for the next edition, where this is letter G instead of letter I, by the way, human resources, and Amanda got it correct. I might have missed that one, I'm sorry.
Or letter G?
Letter I.
Oh, okay.
Yeah, which in the new edition, because I have the solutions manual for the new edition, they've changed the order.
Oh.
So I, in the 15th edition, is G instead. But don't let that confuse you, unless you have the new edition. Then I can convert it for you.
Excuse me.
And letter J, the firm's mission statement indicates its commitment to quality, and the commitment is emphasized in all staff training programs. That is leadership responsibilities. Yeah, that one confused me, but I like the content of these. Now, the other problem I assigned in this chapter has been in the book for years. Oh, I thought, Holmes. It's 2-21. I'm not really going to say much about it here. I'll just read it and maybe you can share a few thoughts with me, and then you can draft something better if you're going to put this in the Dropbox. Don't spend too much time on it, though. Ray, the owner of a small company, asked Holmes CPA to conduct an audit of the company's records. Now, this is a privately held company that normally does not require audits. But it says here an audit was to be completed because they wanted to get a loan from a bank. And the bank is requiring audited financials, even though this is a privately held company. Holmes immediately accepted the engagement and agreed to provide an auditor's report within 3 weeks. Ray agreed to pay Holmes a fixed fee plus a bonus if the loan was granted. It's like, give me an unmodified opinion and I'll give you $10,000. Make it qualified, you only get 6. Give me adverse, I'm going to kick you in the ass and give you nothing. Excuse my French. Holmes hired 2 accounting students to conduct the audit and spent several hours telling them exactly what to do. Basically, he told them not to spend any time reviewing internal controls, but instead to concentrate on proving the mathematical accuracy of the ledger accounts and summarizing the data and accounting records that support the financials. The students followed the instructions. After 2 weeks, gave the financials, which didn't have any footnotes whatsoever. Holmes reviewed the statements, prepared an unqualified, or we would call it now unmodified, auditor's report. The report did not refer to generally accepted accounting principles or to the consistent application of each principle. And they basically want to talk about what they really wanted, the deficiencies. Anyone have any ideas here?
They didn't plan the audit.
Yeah, no planning of the audit at all. So no audit program was prepared. Did the 2 accounting students have the requisite competency and ability to run?
No.
I got the impression they were undergraduate students of tender age who just took managerial and financial. Were they doing an audit?
No.
They really weren't doing an audit at all. They're doing a compilation review. Now, this is an old problem, so they probably had a 10 key and were adding totals. Today, I guess you could check the software to make sure that the correct balances are there. And I guess they were assuming like the subsidiary ledger for accounts receivable would equal the control account in the general ledger. But that's not auditing the appropriateness of the figures, is it? What else? Was gaps being followed here?
No,
Why not?
because they didn't refer to gap.
No, there's no reference to gap and there's no footnotes. I can't picture how you could have a balance sheet, for example, without footnotes. Probably an income statement too.
He was also being paid if the audit came out favorably.
That's right. That type of a
Right.
contingency fee is not appropriate on an audit. Now, we'll see next week, because I won't get to it today. I can't shut up, but I'm just enjoying this too much. We'll see next week that on a tax work, and this always bothers the hell out of me, they allow some contingency fee arrangements. But on an audit, no. You can't have the fee. How is the fee determined on an audit?
That would be biased.
Or how do we determine the fee on an audit?
Isn't it the time that it
Or administrative fee or
Yeah.
something?
Yeah, is the time that each person puts in on the audit times their appropriate billing rate. That's exactly right. Not based on the results of the audit. What happened during that 2 weeks? Remember, the students were out there 2 weeks. Then they gave their work to the audit, the CPA.
what happened?
Yeah, or what didn't happen?
Um,
Was the CPA out there supervising?
no.
I got the impression there was no supervision at all. Not only was there no planning, as you told me earlier, there was no supervision. They were shown what to do, and then they were out there by themselves doing it, and then they gave it to the CPA. And the CPA obviously didn't do proper understanding. You can go through all those quality control measures. Didn't have understanding of the entity, didn't properly establish audit procedures. There were no audit procedures at all. Was there sufficient competent evidence derived?
No.
No, they didn't talk about any evidence at all. I don't see anything about pulling invoices or checking price lists or confirming receivables. There's nothing about that. This was at most a compilation review, checking mathematical accuracy, which you could have probably done in one day with using the computer. So think about that more. Those are some interesting ideas. I've always assigned this question, and it's been in the book for years. Now, all right. Now the rest of the time we'll spend on chapter 3. First of all, I have an old handout that goes back to when the audit report that's in Chapter 3 on page 47 first came into effect. So some of the language is off on this. Then I have new handouts.
So this is an old audit review, right?
Yeah, that's the old one. I'm going to give you a new one.
Thank you.
Let me give you another one so you can, okay.
I could pass it.
Thank you. Barry left and he was my distributing agent here to this side. Now, let me give you these new ones. And let's spend some time. First of all, let me give you this one. I have two that are really essential. That would be in the new edition, by the way.
Is it available anymore? Yes. Thank you.
Thank you.
All right, look, you can read this over on your own, but there's certain aspects I wanted to point out that are on here. And as I said, if we had the 15th edition, it's in there. Okay, first of all, go down, down to about here. Where my finger, where this finger is. New audit report. We have, first of all, and I'm going to pass out one in a second. We have the introduction paragraph. A new paragraph. I don't see this on page 47. They had the report title, report address. Those are the same. Introductory paragraph. What did they have next on page 47? Go to page 47. Scope paragraph. But notice here, the second paragraph is not scope. They call it management responsibility. Then we have auditor responsibility. Then we have the opinion paragraph. And then we have the explanatory or other reporting responsibilities. Now, Bill, can you show us an example of that? This sounds kind of confusing. Yes, I can, and I will do so. So this really should be replacing page 47, and in the new edition, this basically will.
Thank you.
So if we were in the 15th edition, a lot of this chapter reads the same, so it's not like everything is outdated. And we'll go back to this handout in a second. All right, let's take a look at it. Now they're not showing on this handout the title, and that would be their, well, they actually are, Independent Auditor's Report. I'm not, yes, by the way, I'm not sure what this, see where it says Mr. Dim reports crank. I'm not sure what that's referring to. But I saw it was in there, I left it. Maybe that's like mnemonics that Becker uses to remember stuff, I'm not sure.
Yeah, it is, because I took one of the auditing.
Oh, there you go. I was going to say that's what it reminds me, because even in my era we had that with Becker. Fib and Hop and I Go Sick Prego. I don't know what they were anymore, but I remember those.
Yeah.
All right. So, Independent Auditor's Report. Okay, then you would basically have, they don't show it here, you probably should have an address. Like to the stockholders, or to the board of directors, or to the corporation. Now, let's compare this. Maybe it'd be good to compare this report with what's the page 47. Now remember, this one on page 47 was from 1987 through, I think this is around 2013. We have audited the accompanying consolidated financial statements of ABC Company and its subsidiaries, which comprise the consolidated balance sheets as of December 31st, X1 and XO, and the related consolidated statements of income, changes in stockholders' equity, and cash flows for the year that ended, and the related notes to the financial statements. So it's similar but different because there's some additional statements listed, Also, in that introductory paragraph, they talked about whose responsibility was what. That's now broken out into separate paragraphs. Let's look at the next paragraph. Remember, they used to say financial statements are the responsibility of the company's management. One sentence. Now look, a whole paragraph. Management is responsible for the preparation and fair presentation of these consolidated financial statements in accordance with accounting principles generally accepted in the United States of America. This includes the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of consolidated financial statements that are free from material misstatement, whether due to fraud or error. I mean, I like it, but it's a lot more windy, isn't it, than the single sentence that we had previously. Because one of the things we have to make sure management is aware of is that they are the ones primarily responsible for the financial statements. They're the ones responsible, is management. It's their financial statements. Auditor's responsibility. Our responsibility is to, now remember, previously we just had our responsibility is to express an opinion on these financials based on our audits. Our responsibility is to express an opinion on these consolidated financial statements based on our audits. That's the same sentence, but oh, more. We conducted our audits in accordance with auditing standards generally accepted in the United States of America. Those standards require that we plan and perform the audit to obtain reasonable assurance about whether the consolidated financial statements are free from material misstatement. Now, part of that used to be in the scope paragraph. So notice this breakout. There are now three paragraphs that are now constitute the introduction. And this is boilerplate language. Boilerplate legal language. Sometimes there might be a question on a CPA exam where they may give you a report with some erroneous sentences in. So not saying you got to memorize this, you know, like a script for a movie, but be aware of some of these comments. Now let's look at the new scope paragraph. Let's look at the old one first on page. It's kind of nice we got the old one. We conducted our audit in accordance with auditing standards generally accepted in the U.S. These standards require we plan and perform the audit to obtain reasonable assurance about whether they are free of material misstatement. Audit includes examining on a test basis evidence supporting the amounts and disclosures in the financial statements. Audit also includes assessing the accounting principles used and significant estimates made by management, as well as evaluating the overall financial statement presentation. We believe that our audits perform a reasonable basis for our opinion. The new wording, although some of that was kind of alluded to in the introductory part. An audit involves performing procedures to obtain audit evidence about the amounts and disclosure in the consolidated financial statements. The procedures selected depend on the auditor's judgment, including the assessment of the risk of material misstatement of the consolidated financial statements, whether due to fraud or error. So notice they've reworded some of that. In making those risk assessments, the auditor considers internal control relevant to the entity's preparation and fair presentation of the consolidated financial statements in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. That can be part of this report or can be a separate opinion. Accordingly, we express no such opinion. An audit also includes evaluating the appropriateness of accounting policies used and the reasonableness of significant accounting estimates made by management, as well as evaluating the overall presentation of the consolidated financial statements. We believe that the audit evidence we have obtained is sufficient and appropriate, should be to provide a basis for our audit opinion. So they've really expanded that. Notice the references to internal control. The internal control requires a separate audit report, or it can be incorporated into this audit report. This one is not. This one is not talking about the auditor's review of management's assertion of internal control, but they do talk about internal controls. Let's go back to the old opinion paragraph on 47 compared to the new. In our opinion, the financial statements referred to above present fairly, in all material respects, the financial position of, name of the company, dates involved, and the results of its operations and its cash flows of the years then ended in conformity with accounting principles generally accepted in the U.S.
The same thing.
Same thing again. Yes, it did not change. Did not change. Now, after the opinion paragraph, notice it says report on other legal and regulatory requirements. This is where you put appropriate explanatory paragraphs that we'll talk about in a few minutes, would be next. Then the auditor's signature, the city and state, it says date of the auditor's report. Now, our textbook does cover this, the date of the auditor's report. Okay, and I want to read, that's something you may not recognize. Let me see if I can find it again here. The appropriate date, this is on page 48, for the report is the one in which the auditor completed the accounting procedures in the field. The date is important to use because it indicates the last day of the auditor's responsibility for the review of significant events that occurred after the date of the financial statements. In some cases, you'll see a dual dated audit report where the date will exist for part of the report and there'll be a separate date for something else. That relates to significant period